Hi, and welcome back. And this is inventory part 5. And this is another comprehensive example of selling inventory, doing those journal entries, as well as the T accounts. So the information and opinions in this presentation are those of the author only and not the author's employers or affiliated organizations, including but not limited to Irvine Valley College, the South Orange County Community College District, or Chapman University. The presentation is for educational purposes only and does not constitute any legal or accounting advice whatsoever. Any company names or references to publicly traded companies or well-known privately held companies that are used in these presentations are the trademarks and or copyrights of those respective companies. This presentation is copyright 2008 to 2019 by Bennett Tchaikovsky. All rights are reserved. Any distribution is strictly prohibited. So what we're now going to do is we're going to look at a comprehensive problem for inventory sales. And this kind of takes what we went through and did for the purchasing side, but I made a couple other modifications to it. So it's not exactly the same, but hopefully it's going to be enough where hopefully we can learn something new as we will from this particular question. So I'll come back right here to be on a Google Sheet with you. Okay, and we're back. So Cellphones Refurbished Inc., an online electronics retailer, has the following transactions during the month of May 2020. So on May 1st, 2020, I sell 2,000 phones to Rating Bronco Inc. for $40 each on account. The terms are 315 N45 FOB destination. Okay, the phones originally cost CRI $9 each. Okay. So there's two things going on here. And because this is being sold FOB destination, what we need to go through and do is we need to be recording this transaction when the goods are actually received by RBI. And so here they're received on May 4th. So we're going to actually be making this transaction happen, or the sale, on May 4th. So how much do we actually go through and record? Well, the sales here are going to be the quantity sold. So my quantity sold here is going to be 2,000 at 40. My price per phone is going to be 40 bucks. So my total sales amount is going to be $80,000, okay? Now, at the same time, basically my cost of sale, is going to be, or my cost of goods sold, is going to be my quantity sold of 2,000. And then over here, they originally cost me $9 each. So the original cost of the phones was $9 each, or $9 per phone. So my total here, my total cost of goods sold is going to be 2,000 times 9, or 18,000. So by this time, if we're going through and looking at these transactions, and it's really important that when you're going through and doing this, whenever I'm recording a sale, the journal entry that I use is always going to be the same. I'm going to be debiting accounts receivable. I'm going to be crediting sales revenue. And I'm going to do this for 80,000. 80,000 over here, okay? So I'm debiting AR, crediting sales revenue. Then I'm going to be debiting cost of goods sold for here. The cost of goods sold will be for $18,000. And then I'm going through and I am crediting inventory, okay? And this is all happening right here. The transaction date for each one of these is going to be here, will be May 1st. Here, this is going to be May 1st, May 1st. And then over here, this will be on May 1st. Okay, so this is right over here. I'm going to be crediting my inventory for 18,000. So if you're going through and kind of the way I like to handle this part, and we'll kind of see this kind of be a kind of a repetitive thing for this chapter, Whenever I have a sale, the format of the journal entry will always be the same. I debit AR, I'm crediting sales, debiting cost of goods sold, and then I am crediting inventory. So here I'm debiting AR. Wow, Tchaikovsky, good job. Okay, let me get rid of this. My extra credits. Extra credit. All right, so right over here. Okay, there we go. Okay, so right over here, debiting AR for 80, crediting sales revenue for 80, debiting cost of goods sold for 18,000, crediting inventory for 18,000. And again, right over here, assets equals liabilities plus owner's equity, right? DCER, okay? I record revenues with a credit. Okay, I'm increasing my assets because this company owes me $80,000. I increase that with a debit. I am decreasing my inventory because when I sell inventory, inventory is leaving me. So I have to credit the inventory, right? And over here, I'm debiting cost of goods sold, which is a selling expense. So right here, my date here is going to be 5/4. Wow, Tchaikovsky, I'm glad I'm catching you here. This is pretty crazy. I need to record this because it's being sold FOB destination on the date that the goods are actually received, or May 4th. Wow, good job, Tchaikovsky. Okay, so now let's go back over here and take a look at our next one. So our next one right here is we are returning, or RBI is returned. By the way, if RBI is paying for shipping costs, I don't care, right? They're paying those costs. We are not paying those costs. So I'm not concerned about this part right here. If you go back and look at the other video, you'll see how that's handled from that perspective. Okay, so over here, RBI returns 40 cell phones that are found to be defective, and RBI receives full credit. So over here, for my sales return, my quantity returned is going to be, let's give ourselves a little bit more room. There we go. My quantity returned is going to be 40. The sales price per phone was 40. So my total return is going to be 40 times that 40 phones times $40 per phone. And then at the same time, because the item is being returned, I need to show that amount coming back onto my books. So over here, the quantity returned is going to be 40. Okay, my purchase, the cost of that phone, meaning what did I pay for that phone, is going to be $9, right? So my total return, my total inventory returned is going to be 40 times $9 per phone, or $360. So to record a sales return, what I'm going to do right here is I'm going to have sales return, and I'm going to be showing that over here as a debit for 1,600. Okay, this is a contra revenue account, and I'm going to be showing that as a debit. And at the same time, if the goods are being returned to me, that client is not going to pay me, right? So RBI says, hey, I no longer owe you 80, I owe you 80,000 less this 1,600. And so right here, since these items are also being physically returned, what I need to be doing is I need to be showing this inventory coming back onto my books. So the way I'm going to be doing that is I'm going to be debiting inventory right here on 5/5. The amount I debit inventory is for those 40 phones being returned, multiplied by $9 per phone, or my cost for that phone. And then over here on 5/5, what I'm going to be doing over here is I'm going to be crediting my cost of goods sold for that dollar amount. Okay, so that is an example over here of a sales return. Now let's go through and journalize it. And wow, Tchaikovsky, I forgot to do this. Okay, what did I miss here? I missed the description. So here, to record sale to RBI. Okay, So over here on 5/5, okay, I'm debiting here sales returns, and I'm going to be debiting sales returns right over here for 1,600. I'm going to be crediting accounts receivable for 1,600, and then I'm going to be debiting inventory because I'm getting that amount back. I'm debiting inventory for 360, and then I'm going to be crediting cost of goods sold for 360. So to record sales return from RBI. Now, if I'm going too fast on any of this, please make sure to go back and watch the prior videos. Okay, so got this right over here, and now I'm getting over to, give ourselves a little bit more room because some more accounts. And right over here. So I'm now getting to May 5th, or is it May 6th? So our CRI gives a $100 purchase allowance for being a great customer. Wow, how generous. Okay, so we're giving RBI a sales allowance. Now remember, what is a sales allowance? Okay, a sales allowance is something, it's a contra revenue account, and it's essentially just used. It's kind of like we're telling the customer that they don't have to pay us this $100, right? And this is going to be on 5/6. They don't need to pay us $100, but they're not returning any inventory. I'm just giving them an allowance. I'm telling them, hey, you don't have to pay me this $100. Okay. So right over here, I'm going to do a sales allowance for $100 on May 6th, and that's how I record it. A sales allowance is a contra revenue account. Remember, I can never debit sales revenue once I initially record it. I use these contra revenue accounts. So for 5/6, to record the sales allowance right over here, on 5/6, I'm going to debit sales allowances over here for an amount of 100 as a debit, crediting accounts receivable. And this is going to be record sales allowance to RBI. Okay, so for my next one right over here is that's on May 6th. By the way, I'm realizing right here, this $100 purchase allowance is the same thing as the shipping costs. Those are, it's not coincident. It is completely coincidental. I just made up the numbers. In fact, to make this more as a better question, let's go ahead and modify this to say, we'll call this 275. So it doesn't look exactly like the same amount. Okay, so the buyer, in this case, the buyer was paying his own shipping. So we're just going to go ahead and record this right here like this. So again, I changed the number like I do during my tests. If you're taking one of my classes, you're probably not entertained by the fact that I constantly make errors when I write my exams, but I'm human. Okay, so right over here. Okay, so we've got another one here. So we've got RBI finds 30 defective cell phones, and instead of shipping the goods back to CRI, CRI gives RBI a purchase allowance of $1,200. So here we have another, basically here we have another sales allowance. And let me just add this in right here. So over here, we've got another sales allowance. Okay. Okay, let's check this out. So right over here, so finds defective cell phones, and instead of CRI gives RBI a sales allowance. There we go. I had to curse myself. I'm saying I make mistakes, and I do. So I'm giving RBI a sales allowance of $1,200. Now, and again, this one here is I can just give them the $275 if I feel like it. This one here is a little bit different. What here is, I'm saying, look, keep the phones, and I'll just give you a sales allowance of $1,200. And a lot of times, and this is kind of we'll take a little bit of a break here, is that a lot of times when you are going through And if you're doing sales, you want to have that customer keep the goods. And one of the reasons why is because when you look at a retailer, if you get something back from a customer, you cannot sell it as new. And if I go over here to one of my favorite websites, which is called woot.com, and it's working, perfect. Okay, so Apple, MacBook, iPad, and desktop blowout. Sweet, let's check this out. I want some, let's see what this shows us here. Okay, right here. Refurbished, okay? If I click on this right here, quad core desktop, and let's see, refurbished, okay? So once you have something here where you're going through, and if I'm selling something, the reason why I want my customer to keep it is because if I get it back, I'm gonna have to inspect it in my warehouse, and then I can't sell it as new if I get the goods back. So if I can make a deal with a customer, then that's going to be all the better. So right over here, so I'm giving them a sales allowance of $1,200, and we're just going to record that the exact same way over here on May 7th. Debiting sales allowances, crediting accounts receivable on May 7th. So to go through here and record this, what I'm going to go through and do is I'm going to be, again, this will be 5/7. I'm going to have sales allowances, crediting AR. Again, these journal entries never change, okay? And I would recommend essentially just memorizing them. And that's really the best way to do it, is the journal entries never change. And so if you're going through and you memorize the form, like how do I record a sales allowance? It's always going to be a debit to sales allowances and a credit to AR. How do I record a sales return? It's going to be a debit to sales return, a credit to AR, debit to inventory, credit to cost of goods sold. How do I record a sale? Debit to AR, credit to sales, debit to cost of goods sold, credit to inventory. The other thing here is the last one, and we'll kind of start with this first. So on May 4th, they pay the balance due on the cell phones and take advantage of any available discounts. Okay, so right over here, right? So they're paying, the terms are $315 net 45. So in this case right here, they can take a discount because they're paying within 15 days of the sale initiation. Okay. So right here, I'm paying the balance due on the cell phones, taking advantage of any available discounts. So before I get there, the way that we record, so when we get cash from the customer, this is going to be on May 14th. And when I get the cash from the customer, I'm going to be debiting cash. I know I'm going to be crediting AR because they're not going to owe me that money anymore. However, because they're paying me less than what is actually owed, right, they're going to take advantage of that 3% discount. So right over here, I'm debiting cash. I'm going to be debiting sales discounts, and I'll be crediting AR to record cash received from the customer, from RBI. So I know that this is ultimately the form of the journal entry I will do. It never, ever changes. So let's figure out how much we're going to be getting from RBI. So in order for us to do that, and we'll do another one right here because we love T accounts. Okay, so in order for me to go through and do this, I first need to figure out how much does the customer owe me. So to figure out how much the customer owes me, what I need to do first is total up my accounts receivable. And this is why it is so important for you to be going through and keeping track of your transactions as they happen. So right over here, I had a total of 80,000 in debits, and I have a total here of 3,075 in credits. So the total amount that I am owed by this customer, I subtract the smaller from the larger value, and I'm going to get $76,925. So the total AR that is owed is going to be $76,925. The discount amount, and for this question in particular, this was 315 net 45, okay? So again, 315 net 45, that means a 3% discount within 15 days, full amounts due in 45 days. So I'm gonna go over here and I'm going to take this 3%. So my total discount is going to be 2,308. And is this rounded? Okay, well, we're pretty close. I'm going to round it. Okay, we're just going to call this rounded 2,308. Okay, so my total discount is 2,308. So if my the cash received is going to be the total AR of 76,925 less the discount. And my discount here was 2,308. So my total cash received is going to be 76,925 minus 2,308, or 74,617. So I received 74,617 of cash. And let's put this down here into my journal entry. So I've got 74,617 of cash. The same time over here, I know that I'm going to be with my accounts receivable, is that once the client pays me within that discount period, then what happens is they no longer owe me any funds, right? They don't owe me. This receivable balance needs to go to zero. So in order for that to happen, what I need to do is I need to credit this for 76,925 on 5/14. So my total debits are equal to my total credits in this case, and so my balance in accounts receivable is now zero. So I'm going to credit this here for 76,925. And now I've got my last part, which is going to be the amount of my sales discount. So over here, the sales discount is a contra revenue account. And the way I'm going to be reporting that is going to be right over here with a debit to sales discounts of 2,308. So when I debit sales discounts for 2,308, I debit cash for 74,617, and I credit accounts receivable for 76,925. That's how I get everything here to balance. So I add these two up here, 76,925. And this is my journal entry to go through and to show this. Okay. The last thing I want to do here, even though it's not really requiring me to do so, but what does that multi-step income statement look like for just this one transaction? So if I had CRI income statement partial for the month ended, and this is the month ended, 2020, Tchaikovsky, wow, I'm just totally losing it, 5/4/20. There we go. So it's good for the month ended May 31st, 2020. Okay. So I'm going to have my sales, right? And my sales here are going to be 80,000, right? This is coming directly from my T account, my sales revenue. Okay. But here I'm going to go my sales discounts, less my sales allowances, less my sales, my discounts, sorry, my sales less sales returns, less sales allowances, and then less sales discounts will give me my net sales. Okay, so right over here, my sales returns, and again, I'm showing this as a negative amount because it is a contra revenue account. So my sales returns right here were 1,600. My sales allowances were the negative $275, which I gave for somebody being a great customer, and then the $1,200. My sales discounts were $23.08. So my net sales is going to be the combination of these four values here, $74,617. Then I'm going to do my less my cost of goods sold, which are my expenses for selling the items. So my cost of goods sold right over here is going to be, I'll tally these up real quick. I have total debits here of 18,000, total credits of 360, subtracting the smaller from the larger, I get 17,640. So my total cost of goods sold is going to be a debit of 17,640. So my gross profit, and this is, again, this is not disgusting profit, rather it's just what I'm making off my inventory sales, is going to be 56,977. Now, for all you folks at home, you know, some of your instructors may not like the way I'm formatting the income statements. Okay, well, you know, it is what it is. This is a partial income statement because I'm not giving you the other different items you need to complete it. However, this will get you started, and it's really important that you kind of see how do these various different contra revenue accounts actually work, right? They reduce the amount of sales. And for an investor, it's really important for them to say, hey, here were your sales revenues. That's great, but how much are you discounting it by? Wow, okay, this doesn't seem to be that bad. In some industries, there are heavy discounts. And so it's really important for management, as well as the investors, as well as the potential third-party creditors, to understand what is the level of sales return, sales allowances, and sales discounts are. So again, I want to thank you for joining me in this video journey of Defective. Let's see, where else did I screw up? Okay, so that was $275 here for shipping costs. And where else did I mess up? I know I messed up someplace else. I just can't find it right now, but that's okay. We're all human. So, but again, thank you so much for joining me today on this journey. Do not forget to like and subscribe, and I will hopefully see you on the next video. Have a great one. Take care.